Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Today, all eyes in the US market are on Nvidia's earnings report, which will be released after the market closes. Nvidia has been the driving force behind the stock market's recent upward momentum, and any issues with the company could ripple across the broader market. Analysts anticipate that Nvidia's earnings could cause its stock to swing by as much as 8%, making tonight's report and tomorrow's market reaction critical for investors. Meanwhile, Federal Reserve Governor Lisa Cook made headlines with her remarks about future monetary policy. Her comments provided clarity on the Fed's stance, which differs sharply from suggestions floated by analysts and media outlets, such as Bloomberg. Yesterday, Bloomberg proposed that the Fed adjust its inflation target from the traditional 2% to 2.5% to better align with the economic policies of the incoming Trump administration. However, Cook's statements firmly rejected such suggestions. Speaking at the University of Virginia, Cook reiterated the Fed's commitment to the 2% inflation target, stating that moving toward a more neutral policy stance over time would be appropriate. She acknowledged that core inflation remains elevated, underscoring that the Fed has more work to do to reliably achieve the 2% goal. Cook also expressed confidence that inflation will continue to decline, predicting that both headline and core inflation will drop to 2.2% in 2024, well below the suggested 2.5% threshold. This sharp rebuttal signals two key takeaways. The Fed remains resolute on the 2% inflation target, prioritizing monetary discipline over accommodating fiscal policies. Cook's optimistic forecast for inflation next year undermines arguments for loosening the target to 2.5%. This stance marks a notable pushback against Wall Street's recent pressures on the Fed to soften its position. Often, when Wall Street narratives build momentum, investors begin to believe them even if the Fed remains unmoved. Cook's remarks are a clear reminder of the Fed's independence and its willingness to resist external pressures. Adding to the discussion, a new Reuters survey of economists released today echoed Cook's cautious tone. Most respondents expect the Fed to cut interest rates by 25 basis points in December. However, their outlook for 2024 suggests a slower pace of rate cuts, reflecting potential inflationary pressures from Trump's aggressive fiscal policies. Economists now predict a total reduction of 75 basis points next year, equating to just 3 25 basis point cuts. This represents a shift from earlier expectations of a more aggressive easing path. For investors, these developments offer crucial insights into the interplay between Fed policy, market expectations, and fiscal dynamics. Cook's speech and the Economist survey suggest that 2024 could bring a more measured monetary policy environment than many previously anticipated. However, as circumstances evolve, both the Fed and market analysts may revise their views, underscoring the importance of staying informed and adaptable. As always, while it's tempting to predict market movements or policy shifts, a prudent strategy is to remain a follower of market trends rather than attempting to play the role of an all-knowing oracle. Trump's absence at the G20 sparks global debate. Today's Wall Street Journal headline, "Trump isn't at the G20 Summit, but he's dominating the debate," captures the paradox of Donald Trump's influence on global affairs. Although absent from the ongoing G20 summit, his recent election victory has become a major topic of conversation, with leaders worldwide pondering the implications of his return to the White House. From Europe to Asia, Latin America, and Africa, concerns are mounting over how Trump's policies might dramatically shift US stances on trade, health, and the environment. Brazilian President Luiz Inácio Lula da Silva used his opening remarks to advocate for multilateralism, an indirect critique of Trump's America First philosophy. Similarly, Vietnam's President Vo Vien Thanh warned that isolationist trade wars would only lead to recession and poverty, calling for a rejection of zero-sum thinking and nationalism in policymaking. Some leaders at the summit appear eager to signal their willingness to cooperate with Trump in hopes of safeguarding their economies and defense arrangements. Others remind the US of the economic benefits their countries provide through investments and trade. Japan, for example, highlighted its support for the US economy via investments in the auto industry and its plan to increase defense spending to 2% of its GDP. The summit's joint statement also seemed to address Trump's return, emphasizing that global challenges require multilateral solutions to build a better future and strengthen governance for generations to come. However, Trump's campaign promises, such as a potential 60% tariff on Chinese imports, have raised alarm in Beijing, where leaders are lobbying against policies they believe would harm global trade. Notably, China's current economic vulnerabilities leave it less equipped to negotiate from a position of strength compared to Trump's previous term. Despite these efforts, few leaders seem optimistic about persuading Trump to alter his course. Chile's finance minister predicted a shift toward a new era of protectionism under U.S. leadership. A senior Japanese official, while listing Japan's contributions to U.S. economic and defense interests, expressed uncertainty about Trump's stance on these alliances. My take on Trump's global reception. One striking observation about Trump's return is the widespread unease it has triggered across the globe. Whether allies, rivals, or adversaries, few governments view his victory as a benefit to their nations. This signals a perception that Trump's policies prioritize U.S. interests to the exclusion of others, reinforcing his America First agenda. While this approach may align with his base, it leaves little room for other nations to see opportunities for mutual gain. Interestingly, this diplomatic apprehension contrasts sharply with the positive reaction from global financial markets. Unlike political leaders, investors seem unshaken by Trump's return. Markets across the US, Europe, and even China have reacted positively, reflecting confidence that his election won't introduce significant economic uncertainty or systemic risks. This divergence between political and market reactions offers an important insight. While world leaders voice concerns about Trump's potential impact on international order, businesses and investors prioritize stability and growth over geopolitical anxieties. For those closely following Trump's presidency, it's crucial to focus less on the political noise and more on how markets and corporations adapt to his policies. While the rhetoric from global leaders may sound alarming, the financial world's confidence suggests that Trump's leadership is unlikely to derail the global economy. For now, his re-election may bring political disruption, but it's not being viewed as a harbinger of economic chaos. Next, Japan and China reduce U.S. Treasury holdings amid pre-election uncertainty. A recent Bloomberg report highlighted an intriguing trend. Japan and China, the two largest foreign holders of U.S. Treasury securities, significantly reduced their holdings ahead of the U.S. presidential election. According to U.S. Treasury Department data, Japanese investors sold a record $61.9 billion in treasuries during the third quarter, while Chinese investors offloaded $51.3 billion. This sell-off coincided with a rise in Treasury yields, which reached their highest level in 2.5 years by mid-September, as investors anticipated the economic impact of Donald Trump's potential policies. Concerns about Trump's promises of lower taxes and higher tariffs, policies perceived as potentially inflationary, drove this wave of selling. Since then, bond prices have fallen about 4%. Shoki Amori, chief Japan strategist at Mizuho Securities, attributed Japan's sell-off to a mix of pre-election risk management and expectations of higher U.S. yields. In China's case, geopolitical risks amplified concerns, further encouraging investors to reduce exposure to U.S. debt. Bloomberg also noted an additional driver for Japan's moves: currency intervention. In July, the Japanese Ministry of Finance sold dollars to purchase yen, amplifying the reduction in U.S. Treasury holdings. Despite these sell-offs, Japan and China still remain significant holders of U.S. debt, with $1.02 trillion and $731 billion in treasuries, respectively. My perspective on Treasury reductions. While the headline may appear alarming, the sell-off by Japan and China is best understood as routine market activity rather than a dramatic shift in policy or a reaction solely driven by Trump's election. When compared to their total holdings, these reductions represent minor adjustments rather than a wholesale retreat from U.S. debt. China's ongoing strategy of managing its foreign reserves underscores this perspective. Although some commentators have speculated that Beijing could retaliate against U.S. trade policies by aggressively dumping treasuries, such a move would likely be counterproductive. With foreign reserves totaling over $3 trillion, China's options for diversifying away from the U.S. dollar are limited. Treasuries remain one of the safest and most liquid assets available. Similarly, Japan's reduction is tied partly to domestic financial considerations, including its efforts to stabilize the yen. These moves reflect practical adjustments rather than a fundamental loss of confidence in U.S. debt. For investors and observers, it's essential to avoid over-politicizing these developments. While headlines about selling off U.S. treasuries can spark concern, the broader context shows these actions as measured responses to changing market dynamics rather than a harbinger of financial instability. Next, let's focus on Trump's hush money case sentencing delayed, legal and political implications. A Bloomberg report sheds light on one of the most debated issues in U.S. political discourse recently, the delayed sentencing in Donald Trump's hush money case. According to the report, the November 26 sentencing date for the former president has been cancelled, with the court providing no explanation for the update in its records. Key developments in the case. The delay stems from the complexities of handling a legal case against a sitting president-elect. Manhattan District Attorney Alvin Bragg faces the challenging task of proposing how to proceed with a case already ruled on by a jury, which found Trump guilty of falsifying records to conceal a scandal. In a letter to the judge, the prosecution emphasized 2 points. Upholding the jury's verdict. Bragg's team urged the judge to reject Trump's legal team's request to dismiss the case, reinforcing the importance of respecting the jury's guilty verdict. Balancing justice and presidential responsibilities. The letter stressed the need for a delicate balance between the integrity of the criminal justice system and the responsibilities of the presidency. The prosecutors suggested freezing sentencing until Trump completes his term, acknowledging the unprecedented legal challenges involved. Trump's legal team, however, has pushed for the case to be dismissed entirely, arguing that any delay undermines justice. Confusion on social media. On November 20, reports falsely claimed that Trump's hush money case had been dismissed. These claims gained traction on social media, particularly on X, formerly Twitter, leading many to believe that Trump had been cleared. However, X took an unusual step by issuing corrections, labeling these claims as misinformation. This development surprised some observers, given Elon Musk's perceived alignment with Trump. Despite Musk's apparent influence on excess content moderation, the platform displayed a measured approach in addressing the spread of inaccuracies about Trump's legal standing. What's next for the case? The legal trajectory of the case remains uncertain. While the prosecution has agreed not to disrupt Trump's presidency with immediate sentencing, the ultimate decision rests with the judge. Should the judge adopt the prosecutor's suggestion, Trump's legal team is expected to escalate the case to the Supreme Court, setting the stage for a prolonged legal battle. For now, the hush money case appears to be evolving into a protracted judicial conflict, potentially spanning years and further entrenching it as a political flashpoint. My take on the situation. This case underscores the tension between legal accountability and the unique privileges of holding the presidency. While the delay may seem like a victory for Trump, it also prolongs uncertainty and fuels partisan narratives. The role of platforms like X in moderating misinformation about such high-profile cases highlights their growing responsibility in shaping public discourse. It also demonstrates that, even amid perceived biases, efforts to correct false narratives are possible. Ultimately, this case's resolution will hinge on legal precedent, judicial discretion, and Trump's ability to navigate the challenges ahead. Whether or not the case concludes during his presidency, one thing is clear: the hush money case is far from over. Finally, let us turn our attention to Ukraine. Bloomberg report today revealed that Ukraine has, for the first time, used British-supplied Storm Shadow missiles to strike military targets inside Russia. This marks a significant escalation in the ongoing conflict and provides evidence of the UK's approval for Ukraine to use its weapons beyond its borders. Details of the strike. According to a Western official familiar with the situation, the Ukrainian military launched these missiles as the war surpasses its 1,000th day. The official stated that the UK's approval of the Storm Shadow missile strikes was a direct response to Russia's decision to involve North Korean forces in the conflict. The UK government views this as a dangerous escalation, aligning its justification with the US, which recently allowed Ukraine to use American missiles for strikes within Russian territory. While the US made a public announcement about loosening restrictions on missile usage, the UK and France had not confirmed similar permissions. Today's strike, however, serves as implicit confirmation of the UK's stance. This raises speculation about whether France might follow suit, potentially allowing its Scalp-PG missiles to be used in a similar manner. Market response and geopolitical implications. Interestingly, global markets have remained unaffected by the heightened tensions. This contrasts sharply with the reaction to previous threats from Russian President Vladimir Putin regarding the use of nuclear weapons. Last year, such threats caused momentary jitters in financial markets. This time, however, there has been little to no response, signaling a shift in how international markets perceive Russia's rhetoric. My take on the situation. The use of Storm Shadow missiles marks a turning point in the conflict, as it signals a growing consensus among Western allies to loosen restrictions on Ukraine's use of advanced weaponry. The justification from both the US and UK, that this escalation is in response to Russia involving North Korea, suggests a coordinated message aimed at holding Moscow accountable for broadening the war's scope. From an international perspective, the lack of market reaction to Putin's nuclear threats is notable. It highlights a diminishing fear of Russia's ability, or willingness, to follow through on such statements. This lack of response may serve as an indirect critique of Russia's current geopolitical standing, with markets and global players treating its threats as mere posturing. For Ukraine, the deployment of these missiles sends a powerful message: its Western allies are increasingly willing to support strikes beyond its borders, signaling that the rules of engagement are shifting. How Russia responds to this development will likely shape the next phase of the conflict. This situation continues to evolve, but one thing is clear: Ukraine's strategic use of Western weapons is forcing Russia to reassess its approach, both militarily and diplomatically. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.